Is Apple a buy at $210 per share? And if you want to build indestructible generational wealth, is Apple a good choice as a long-term investment? The only way to know is via fundamental analysis to find the intrinsic value. I spent the last week putting together a full fundamental analysis on Apple based on their recently reported 2Q25 results. Trading at $210 per share, I have a hold rating on Apple stock. In my research, I discovered 7 things that got me very excited and 6 red flags to watch out for with Apple. So what did I discover? What's my value for Apple stock? And what's an ideal entry point should you decide to become an Apple shareholder? In this video, I will cover Apple's recent results and what everyone is missing, what I think about Apple stock and what my analysis uncovered, what Wall Street smart money says and how it can impact your portfolio, and how you can use this information to build wealth and what you must do if you decide to buy. Are you an investor in Apple stock? Why or why not? Let me know in the comments below. Apple released 2Q25 results that beat estimates, but the stock ended up falling due to investor concerns about future growth and challenges in China. If you're enjoying this, please smash that like button. Let's cover the red flags first. Apple's upcoming COO changes leave a big question mark over who will eventually succeed Tim Cook, raising fears of a leadership vacuum. And Apple's top AI executive left to join Meta, and another high-level AI researcher, Tom Gunter, has also left.
Oh, that's not good.
Investors should watch how these transitions affect Apple's next era and the impact on its AI rollout.
Breaking news coming from Apple announcing a chief operating officer transition. Jeff Williams is stepping down from his role as COO.
Wall Street insiders say that Apple stock is stuck on lemonade breaks, while rivals zoom ahead in AI, casting doubt on its ability to keep pace. Apple paused its AI-powered news alerts after they pushed bogus headlines, spotlighting quality gaps in Apple's own AI stack.
iPhone drop.
This could leave Apple scrambling to catch up in the next tech frontier. Trust and future rollouts are now in question.
It does feel like in this AI highway, going 100 miles an hour, OpenAI, Google, Microsoft, that Apple's at a rest stop, sitting there just watching it, drinking lemonade.
A federal judge has allowed a major antitrust lawsuit to proceed against Apple, alleging monopoly abuses in its App Store.
Saw that coming.
This threatens Apple's core ecosystem and could lead to hefty damages.
The U.S. government's antitrust suit against Apple is slowly but steadily moving forward. And while Apple has done a pretty good job of keeping this out of the headlines and everyone assumed it was going to go away, it is not going away. In fact, Apple's latest motion to dismiss this lawsuit was denied, and it keeps going forward. And remember, this is a pretty big landmark case. Apple is being accused of anti-competitive monopolistic practices over the mobile smartphone arena, the App Store, all of those things sort of tied together.
Apple says the latest tariffs will slap about $900 million onto costs this quarter, biting straight into the cash that it makes on each iPhone unless it finds a workaround. President Trump threatened a 50% EU import tax and a 25% tariff on Apple products unless iPhones are made outside of China, injecting fresh policy risk. Apple has to thread the needle, mitigate cost increases, and fix their supply chain fast.
The president had this message for Apple's CEO Tim Cook. He says, quote, "I expect their iPhones sold in the United States to be manufactured and built in the United States, not India or any place else." He adds, if that is not the case, a tariff of at least 25% must be paid by Apple to the United States.
Greater China revenue slid 2.3% to $16 billion, making a 7th straight decline. No quick rebound is in sight. Investors now question when demand will stabilize.
They were already banking on billions of dollars in hits to their bottom line for the coming quarter. And so now one of the experts that I had spoken to, Gene Munster over at Deepwater Asset Management, said, look, now we have to start looking at the December quarter as well, because if anything does happen, if anything does change with regards to China or any of these other major supply chain countries, that would start to be then reflected in the December quarter. And so that's going to be a major time for Apple.
Apple's wearable home accessories segment shrank 5% year over year, its first contraction since the line was introduced, signaling softness beyond the iPhone. Slowing demand for Watch and AirPods puts more pressure on services to drive growth.
Get to the good part.
Here's what got me really excited. All processing happens on your phone, no cloud handoffs. Letting every developer plug in should multiply useful features fast.
Well, look, last year they announced the big Apple Intelligence push, right?
They did.
That was the first part of the story, because there's two parts to it. We all want the deep conversational Siri thing going on, but for that to work, us app developers have to expose our logic, our data, our functionality to the system. And last year, Apple announced a whole bunch of code just for that. So now we've been working, there's tens of thousands of developers using this stuff now called App Intents.
Apple's brand is so sticky that fans upgrade for tiny tweaks, just like hardcore sports fans buy every new jersey. Even boring iterations keep Apple in the spotlight, driving sales without risky moonshots.
Look, this has become one of the stickiest consumer product brands in the world. I can't think of any other product where its users have a deeper relationship with the product. At its core, Apple is the perfecter. It's rarely the innovator and disruptor, and it's built just an incredible monetization engine on top of that.
Big buyback shows that the company thinks its own stock is a good deal, and it rewards shareholders. Fewer shares in the market mean each remaining share is worth more. Any recent iPhone can now act as a credit card reader, no extra gadget needed. More places using tap to pay means more fees flowing back to Apple. Xcode 26 bakes in ChatGPT and lets coders swap in any model, even local ones. Tens of thousands already using new app intents to plug app logic into Siri and AI.
So now we've been working, there's tens of thousands of developers using this stuff now called App Intents.
Yeah.
They all work, they're great now. Hopefully today, Apple go, right, we've got your data, let's go for it and ship something great, all being well.
A $1.5 billion expansion lets more iPhones ship from tariff-safe India. Building in India helps Apple dodge the White House's threat of a 25% iPhone import tax.
Clearly, the president is a little frustrated with recently announced plans from Apple to invest more than $1 billion into a new Foxconn plant in India. Obviously, the administration would like to see that investment here stateside instead.
This is what everyone is missing. The new Texas factory will build the servers that power Apple Intelligence. Huge US-based spending and jobs creation wins political goodwill as trade rules tighten and the landscape changes. When it comes to any stock, I let the numbers tell the story, and that involves looking at the company's 3 financial statements. Would you buy a house without knowing the size, location, dimensions, or condition?
No.
That is exactly what you're doing when you buy a stock without understanding the 3 financial statements. If you want to value companies like the world's top financial analysts on Wall Street, check out my school community, Win Like Wall Street. Just scan the QR code on the screen. The balance sheet shows us how the business is funded. If assets grow faster than liabilities, equity increases, and we win. Apple has almost $30 billion of cash, and if we combine it with cash invested in securities, it's over $156 billion. Looking at that $156 billion, Apple would be the 7th largest hedge fund in the world based on assets under management. This gives the company a ton of money to return capital to shareholders and invest in the future, whether it's AI or the next amazing iPhone. At year end, the company had a little more than $106 billion in debt, but it's been declining since COVID. Apple is net cash, which means cash is greater than debt by about $50 billion at year end and $35 billion as of the most recent quarter. This gives Apple massive financial flexibility, and it's much of the reason behind its stellar AA+ credit rating. Retained earnings is declining, which is normally a red flag, but it's not because the company is losing money. It's actually because Apple is returning so much capital to shareholders via dividends and share repurchases. We're going to see this later on when we cover the cash flow statement. So what's the takeaway? Apple has tons of cash, its debt is manageable, and it's returning billions of dollars to shareholders. The income statement shows us if the company is generating profits. We want to see revenues grow faster than expenses, which will grow profits. The way we determine how effective a company is at generating profits is via margin. Revenues minus expenses equals income. Income over revenues equals margin. If a company has higher revenues and lower expenses, it will have higher margins. If revenues grow faster than expenses, margins will get bigger or expand, which is is what we want to see. Last year, Apple generated a staggering $391 billion in revenue, with nearly 25% coming from services, which includes iCloud, Apple Care, Apple Pay, and the App Store. Overall, revenue growth was only 2% because Apple's business in China suffered a decline of almost negative 8%. While China boomed after COVID, it has been on a steady decline since. Margins expanded across the board, which is a tremendous positive, showing operating efficiency, with the exception of net margin. This is due to a one-time tax in Ireland of over $10 billion from a dispute which has been unresolved since 2016. Apple has averaged over $96 billion in net profits over the last 4 years. This, coupled with expanding margins, shows that they are managing costs effectively and have plenty to return to shareholders. So what's the takeaway? Despite softness in China, Apple is still growing strong, expanding margins, and increasing profits for investors. The cash flow statement tells us where the cash is generated by the company, and there are 3 buckets. Operating, which is the cash the company generates internally, investing, which is the cash demanded for long-term growth, financing, which is the cash the company generates externally. When we add these together, we get the net change in cash. We want to see companies generating cash, making this positive, not losing cash, which would make this negative. Operating cash flow is positive and growing rapidly. The operating cash flow is primarily driven by the strong net income that Apple is generating. Investing cash flow is positive, which is rare, though it's a silver lining. While long-term investment in the business, or CapEx, usually results in negative investing cash flow, Apple has generated over $402 billion from its invested cash over the last 5 years. Apple is using these massive cash returns and giving it to shareholders. Over the last 5 years, Apple has returned a staggering $494 billion to shareholders via dividends and share repurchases. So what's the takeaway? Apple is using its massive pile of cash to generate income, which it's then returning to shareholders and reinvesting in the business for the long term. So what does this all mean for the valuation of Apple stock? Let's cover that next.
Let's hear it.
On Wall Street, we build a discounted cash flow model to measure the intrinsic value of companies. Because companies generate cash flow and we projected the 3 financial statements, we could take these future cash flows, discount them back to today to get a current intrinsic value for the company. We cannot do this type of valuation with crypto, baseball cards, or art because they have no cash flows. If you want to learn how to value companies like we do on Wall Street so that you could build generational wealth, scan the QR code on the screen to join my school community, Win Like Wall Street. Also, you could check out the step-by-step video I did on building a DCF model, which includes an Excel file. The link to that video appears above and is in the description. As you can see on the left, we take specific line items that we projected from the 3 financial statements. We use these line items to calculate free cash flow to the firm, or FCFF. To this, we add a terminal value, which is the value from the end of the model out to infinity, because the company does not stop operating when our model ends in 5 years. We discount these cash flows back to today to get to total enterprise value. To get to equity value, we strip out the debt, we add the cash, we strip out non-controlling interest, we add associate investments. We get an intrinsic equity value of $3.03 trillion. We divide by the current shares outstanding, we get an implied share price of about $203 per share. Compared to the current close of $210, that's a 3.7% premium, which would be a sell rating. Now, in the case of Apple, it's pretty much marginal, so I would actually call this a hold. On Wall Street, if a stock is trading at greater than a 20% discount, it's considered a buy because it provides us with a margin of safety. So what does Wall Street have to say about Apple stock, and how can that impact your portfolio? Let's cover that next.
Everybody on? Good.
In general, analysts are cautiously optimistic about Apple, but they're more concerned about the lagging growth in China and the lack of any visibility as it pertains to artificial intelligence. Barclays kept an underweight rating and a $173 target, calling the iPhone X growth, and warning that services are very concentrated and at risk, while other products are irrelevant for valuation. UBS kept a neutral stance with a target of $210. They noted that the App Store growth of about 13% year over year is great, but they're warning it does not foresee a significant acceleration in services revenue later this year. Evercore reiterated an outperform rating and a $250 target after a key AI executive left, saying Apple's prudently flexible and cost-conscious AI strategy still offers multiple monetization paths. I like looking at Cap IQ to see how other analysts on Wall Street view the company. 40 analysts cover Apple on Wall Street. The target price is from a low of 173, which is an 18% decrease, to a high of 300, which is a 43% increase. Upside outweighs downside by about 2.4x. 43 up, 18 down. Hedge funds typically look for a ratio of 2 times or above. The median is 230, which is a 9% increase. The overall rating on a scale of 1 to 5 is 2.07, which is an outperform rating.
You should seek the advice of an investment professional always. I do not know your individual financial situation. This content is meant to educate and is not investment advice.
That being said, I did have a small 3% stake in Apple, which I sold in late May when it hit my January bull case valuation of 206. I owned Apple at a cost of $128 per share and booked a 61% gain because there were better opportunities to invest in. That being said, I am a believer in the company and I'm looking to re-enter the stock. If you decide to buy Apple, I'll tell you exactly how to build a position, which I'll reveal shortly. From 3Q23 to 3Q24, Buffett sold over 615 million shares in Apple, reducing his stake by half. While this seems like a major negative, it was a portfolio management move because Apple was 50% of his overall portfolio and now it's 25%. From these sold shares, he missed out on another $25 billion in gains from Apple.
Big league money, man.
Apple announced a new commitment of $500 million with MP Materials, the only fully integrated rare earth producer in the United States. The two companies will work together to establish a cutting-edge rare earth recycling line in Mountain Pass, California, and build a state-of-the-art Texas factory with manufacturing lines specifically designed for Apple products.
Your future is our future.
Under Tim Cook's 14-year tenure, Apple has achieved an 18.4% compound annual growth rate, and he has created far more shareholder wealth than Steve Jobs had, bringing the company from $300 million to $3.2 trillion in market cap. Waiting on AI lets Apple perfect the technology and cash in later, the mindset being rarely first, always best.
Tim Cook has been incredible at keeping Apple not just a perfecter, but focused on being operationally disciplined and creating value. It's rarely the first market. It's almost always the best market. I think Dan's right. I think the AI example is going to just prove to be another case of it.
Yes, we need to see an AI plan from Apple, and I want to see them turn around things in China. But let's remember, for the last 40 years, Apple has proven to be one of the greatest innovators in the tech space, and it has rock-solid financials.
I would like an iPhone.
Margins are expanding. The company is net cash by almost $35 billion, and they're returning hundreds of billions in cash to shareholders while investing in the future. Apple hit an all-time high of 260 at the very end of 2024, and it's down over 19% since. Apple reports their 3Q25 results at the end of July on July 31st after the market close, so there will probably be movement in the stock. We definitely need to see some definitive plans in the AI space and ideally a turnaround in China for the stock to be able to rebound. To me, the stock becomes much more interesting under $200, and an ideal buying range would be in the 170 to 175 range. My model shows a value of 203, which is a 3.7% premium at current levels. On Wall Street, we buy with a margin of safety of at least 20%. So Apple is a marginal hold at current levels. And if you decide to add it to your portfolio, this is what you should do. Decide how much capital you want to allocate to the position. I typically choose 10% as my max, but start small and build over time. Utilize limit buy orders so that you're not chasing the stock. Break your purchases into pieces so that you dollar cost average into the position.
Noted. Noted, yes.
If you like this and want to see another in-depth stock valuation, check out my Rivian video here or my Lululemon video here. And if you found this valuable, please share this with someone who you think would enjoy this. As always, be relentless.